Digital Assets for Investors. Chapter 13. Trading Psychology. Section 1. Fear and Greed. Fear and greed sit underneath a huge number of trading mistakes. Neither emotion is unusual or unhealthy on its own. The problem starts when emotion becomes the decision maker instead of the trading process. In falling markets, fear can make every candle feel like a warning that you must act immediately. In fast rallies, greed can make extra risk feel justified because the move looks easy and everyone else seems to be participating. In both cases, analysis gets pushed aside by urgency. That is why disciplined traders rely on rules most when emotions are strongest, not when markets are calm. Fear often disguises itself as caution, which is why it can be hard to spot in real time. It may push you to exit a good trade too early, avoid a valid new setup, or react to headlines instead of price structure and risk levels. Fear can also create a strange contradiction. Some traders cut winners quickly but hold losers too long because realizing the loss feels painful. In that moment, the emotion feels protective, as if doing something immediately must be safer than following the plan. But if the trade has not actually violated your rules, fear is usually pulling you away from a better decision. The key is to compare your action to the original plan, not to the discomfort you feel in the moment. Greed is not always loud or obvious. Often it shows up as a feeling that you should press harder because the market is rewarding boldness. That can lead to using more leverage than usual, increasing position size too quickly, or chasing a move after much of it has already happened. A trader under the influence of greed may also ignore exit rules because the upside feels unlimited. The dangerous part is that greed often looks like confidence, especially during a strong rally. But confidence without risk control is just exposure. If the plan says one size, one stop, and one setup, greed begins the moment you decide those limits no longer apply. Emotional trading tends to follow a loop. A sharp move in price triggers a reaction. That reaction makes clear thinking harder, and the trader responds to the feeling instead of the setup. The result of that impulse trade then reinforces the habit, especially if the emotional decision happens to work once or twice. That is how bad patterns become familiar routines. The most useful interruption is a pause between the emotional trigger and the trade itself. Even a brief pause creates enough distance to ask whether the setup still matches your rules. In practice, that pause is one of the most valuable tools in trading psychology. One reason emotional trading is so difficult to manage is that it usually feels reasonable while it is happening. Selling into weakness can feel like self-protection, especially when headlines are negative and other people are also turning defensive. Taking more risk into a strong rally can feel like seizing an opportunity before it disappears. FOMO makes greed feel smart, and bad news makes fear feel responsible. That is why emotional decisions are rarely obvious from inside the moment. The trader does not think, "I am being emotional." The trader thinks, "This is the sensible thing to do right now." This is where planning earns its value. A trading plan is most useful before emotion rises, because it gives you a structure to return to when markets start moving quickly. If entries, exits, and risk limits are defined in advance, you do not have to invent decisions under pressure. You can also go back to the original trade thesis and ask whether anything material has changed. That keeps short-term noise from taking control of the process. A good plan does not remove emotion, but it gives emotion less room to rewrite the trade. Consider a simple fear-driven mistake. A trader buys $5,000 of stock at 50, sets a stop at 48, and sets a target at 55. The price drops to 48.50, which is uncomfortable but still above the planned stop. Fear takes over, and the trader exits early to avoid the possibility of a larger loss. Later, the stock recovers and reaches the original target. The lesson is not that every trade will bounce back, but that abandoning a valid plan before the invalidation point changes a planned trade into an emotional one. The opposite mistake often appears after the rebound. A second trader sees price already moving from 52 to 54 and decides to enter late because the move looks strong and exciting. To make the opportunity count, the trader increases position size and skips the stop loss entirely. At that point, the trade no longer has defined risk. It is just hope attached to momentum. If price reverses sharply, The late entry and larger size work together to magnify losses. This is a classic greed pattern. The move feels safest precisely when risk to reward has often become weaker. Strength in price does not replace the need for a plan. Emotional mistakes tend to repeat in recognizable forms. You might sell during a normal retracement, chase a rally without confirmation, or refuse to honor a stop because you want the market to give you one more chance. After a series of wins, you may feel unusually confident and start risking more than usual. After a loss, you may avoid the next valid setup because your confidence has dropped. These are different behaviors, but they come from the same source, emotion-changing execution. The more quickly you can recognize your own recurring pattern, the easier it becomes to interrupt it. A practical way to improve is to review your recent trades with honesty and specificity. Ask what price action triggered the decision, what emotion you were feeling, and whether you actually followed the original plan. If you did not, identify exactly what changed and whether that change was real new information or just emotional discomfort. Then ask what the plan should have dictated instead. This kind of review turns vague self-criticism into usable feedback. It also prepares us for the next section, because one of the most common forms of greed in markets is the urge to chase attention and excitement. Section 2. FOMO and hype cycles. FOMO is the pressure to act because it looks like other people are making money without you. In trading, that pressure often appears when price starts moving fast and the window seems to be closing. The urge is not based on a complete setup, a clear thesis, or a defined risk plan. It is based on urgency. That is why FOMO entries are often irrational. The trader is reacting to the fear of being left behind, not to evidence that the trade is still attractive at the current price. In fast markets, recognizing that difference can save a lot of capital. Hype cycles usually begin with something real. There may be a news event, a genuine catalyst, a strong earnings report, or a narrative that has some truth behind it. As price starts rising, attention increases, and that attention attracts new buyers. More buyers can push price even higher, which creates even more visibility. At that point, the move starts feeding on itself. The important idea is that a valid catalyst can begin a move, but attention and price can then carry it beyond what a disciplined setup would justify. Traders need to separate the original reason from the crowd reaction that follows. This is the usual emotional path of a hype move. Early participants notice momentum and enter when the setup still has room to work. As the price keeps rising, social proof grows and the trade starts to feel obvious. By the time everyone is talking about it, emotion is often near its peak, and late buyers begin rushing in. Ironically, that is also the stage when much of the upside may already be behind the move. Once momentum stalls, the reversal can be quick, because the same crowd that chased the rise may rush to protect profits or cut losses. Visibility tends to rise late, not early, and that matters. FOMO trades are costly mainly because the price is often wrong, even if the story is not. After a large move, the remaining upside may be limited while the downside becomes much larger if momentum fades. Early buyers have room to take profits, but late buyers often have very little margin for error. A trade can still be based on a good idea and still be a bad trade at a bad price. That is one of the hardest lessons for newer traders to accept. In markets, being right about the asset does not guarantee being right about the entry. Once FOMO takes control, discipline usually starts breaking down in very specific ways. Entry criteria get ignored because waiting feels too expensive. Traders buy without a risk plan, skip stops because they do not want to be shaken out, and use oversized positions because the opportunity feels unusually special. If the move reverses, they may keep holding out of hope instead of respecting the original limits. All of these are risk management failures, not just emotional discomfort. FOMO is expensive because it turns a structured decision into an impulsive one. Imagine a stock jumps from 10 to 15 on real news, and online excitement builds quickly around the story. By the time you notice it, the stock has already pushed 18, and you buy because the urgency feels impossible to ignore. Soon after, the hype fades and the price falls back to 14. The asset may still have long-term potential, but that is not the issue in this example. The issue is timing, discipline, and the absence of a clear risk plan. A compelling story does not automatically make a late entry a good trade. During a height move, weak reasoning can feel unusually convincing. Traders buy highs without understanding the broader context, treat attention as proof, and rely on one post or one headline instead of a full setup. Some enter before defining where they will exit if the trade fails. Others compare themselves to screenshots of gains from people whose position size, timing, and risk tolerance they do not know. Attention is not evidence, and excitement is not confirmation. The better approach is to move in the opposite order: first context, then thesis, then risk, then entry and exit. Simple rules are often the best defense against chasing. One useful rule is to wait after a sharp jump rather than entering at the most emotional moment. Another is to write the setup in plain language so you can tell whether there is an actual edge or just excitement. You can also reduce position size after unusually large moves, because extended markets deserve more caution, not more aggression. And before buying, define the risk and exit just as carefully as the entry. These rules do not guarantee perfect timing, but they create enough structure to resist urgency. A disciplined response to hype begins with a pause. Ask what the actual catalyst is, when you first noticed the move, and what today's price action looks like relative to the peak. Those questions help you separate a real setup from emotional lateness. It is also helpful to write one rule for next time, because the goal is not just to survive the situation, but to improve your future behavior. Sometimes the best decision is to wait, and sometimes it is to skip the trade entirely. Missing a move can feel frustrating, but a rushed trade usually does more damage than a missed one. From here, the broader skill we need is emotional discipline under pressure. Section 3. Emotional discipline. Emotional discipline does not mean becoming emotionless. It means continuing to follow the trading plan even when fear, excitement, frustration, or regret become intense. Feelings will show up in every trader. The difference is whether those feelings are allowed to change the rules in the middle of execution. That is why execution matters as much as analysis. A strong setup on paper has little value if the trader cannot carry it out as planned. Emotional discipline is really the skill of keeping process intact under pressure. Poor discipline is costly because the biggest damage often happens after the analysis is finished. The trade may begin with a sound plan, but then position limits get ignored, stops get widened, or entry rules are quietly abandoned. When that happens, the strategy you think you are trading is no longer the strategy you are actually exposing capital to. Planned risk and real risk start to drift apart. This is why rules matter so much. They protect capital from very human reactions in moments of stress. Without discipline, even a reasonable strategy can produce unreasonable outcomes. This connects directly to risk of ruin. Risk of ruin is the chance of losing enough capital that trading effectively becomes very difficult or impossible. Poor discipline raises that risk because small rule breaks can compound faster than most traders expect. A losing streak may tempt revenge trading, while a winning streak can create overconfidence and oversized bets. In both cases, the worst behavior often appears at the worst possible time. Survival in markets depends less on brilliance than on respecting limits when emotions are trying to push past them. It is important to separate discipline from hesitation, because they can look similar from the outside. In both cases, no trade is taken. But discipline means the setup did not meet written criteria, so staying out was correct. Hesitation means the setup was valid, but fear or uncertainty prevented execution. One protects your edge, and the other prevents the edge from ever being tested consistently. The difference is not how you felt. The difference is whether the setup actually matched your rules. Strong discipline begins before the market opens. Rules need to be specific enough that you can verify them under stress, not vague enough that emotion can reinterpret them. Define risk per trade, set a maximum daily loss, and write down the exact entry conditions required before you act. It also helps to name market conditions you should avoid, such as unusually chaotic volatility or times of day that do not suit your strategy. Measurable rules reduce the space for improvisation. Under pressure, clarity is a real advantage. A pre-trade checklist turns discipline into a repeatable routine. Before taking a trade, ask whether the setup actually meets your criteria where the entry, stop, and exit are, whether the position size is correct, and whether you are still within your daily loss limit. Then ask the most revealing question of all: am I trading the plan or the urge? If you cannot answer those questions clearly, the trade is probably not ready. Checklists may seem simple, but simplicity is exactly what helps under emotional pressure. Routine gives you something solid to rely on when feelings become noisy. Loss of control often shows up in the body before it shows up in the trade. A rapid heartbeat, sweaty palms, jaw tension, or a compulsive need to watch every tick can all be warning signs. The same is true of strong self-talk like, "Fix this now," or "Don't miss it." These cues do not necessarily mean the trade idea is wrong. They mean your execution may be at risk. When you notice them, the goal is not panic, but awareness. Pause, breathe, and return to the plan before the next click. Once a trade is live, discipline means executing the trade you already approved. Respect the planned stop, take the planned exit, and do not widen risk just because the market is making you uncomfortable. The same goes for adding to a losing position unless your rules specifically allow it. If the trade needs new logic to stay open, then it is no longer the same trade. That is often the moment when emotional reasoning tries to disguise itself as flexibility. Real discipline is staying aligned with the original conditions, unless truly new evidence changes the setup. Take a $10,000 account, planning a breakout trade near 50 with a stop at 48 and 100 shares. That creates $2 of risk per share, or $200 total, which stays inside a $300 daily loss limit. If the stop is honored, the loss remains controlled and the trader can continue operating with capital intact. If the stop is moved lower, that same manageable loss can quickly become something much larger. The market did not create that larger loss, the rule break did. Good discipline is often nothing more glamorous than keeping a small loss small. Discipline improves through review and repetition, not through motivation alone. After each session, review the process, not just the profit. Track where rules were followed, where they were broken, and what emotions were present at the time. Look for repeating patterns such as revenge trading after losses, overconfidence after wins, or constant checking of price and P&L. It is also important to judge execution separately from outcome, because a profitable trade can still be poorly handled, and the losing trade can still be managed well. That distinction leads naturally into patience and consistency, because long-term improvement depends on repeating good behavior across many trades. Section 4. Patience and consistency. Patience and consistency are what give a strategy a fair chance to work. If you keep changing how you trade from one setup to the next, you never really test the edge you believe you have. Patience means waiting for qualified setups instead of forcing action. Consistency means taking valid signals the same way and keeping risk rules stable from trade to trade. Over time, that allows probabilities to play out instead of being distorted by mood and impulse. Trading becomes much clearer when you stop asking each trade to prove everything by itself. Patience is not passive waiting, and it is not stubborn hope. It is disciplined waiting for predefined conditions to appear. That means doing nothing until the setup is actually present, then acting when the criteria are met. It also means refusing to confuse waiting with holding blindly just because you have already spent time or money on the idea. Sunk cost thinking is dangerous in trading because past effort does not improve a weak setup. Patience protects the process. Hope ignores it. Many traders confuse activity with seriousness. But in markets, more action does not automatically mean better work. Every trade carries fees, slippage, risk exposure, and mental cost. If there is no valid setup, staying out may be the highest quality decision of the session. A quiet day with no trades can still be a successful day if the process was followed correctly. Busy does not mean productive, especially when activity is coming from boredom rather than edge. Consistency is what reveals whether a strategy actually works. An edge does not show itself in one or two trades. It appears over a meaningful sample. That is why position sizing, stop-loss rules, and setup criteria need to remain stable long enough for the probabilities to become visible. If you skip one valid setup, double size on another, and widen risk after a loss, the sample becomes contaminated. You can no longer tell whether the strategy failed or the execution did. Stable execution gives the data a chance to speak clearly. Patience often breaks not because of the current setup, but because of the emotional weight of the previous one. After a loss, Traders may revenge trade or become so cautious that they hesitate on the next valid signal. After a win, they may feel invincible and take weaker setups or larger size. But each signal should be treated as a separate event. The last trade does not change the rules for this one. Consistency requires emotional reset between outcomes. A good trading plan can evolve, but the timing of change matters. During live execution, the job is to follow the current rules as written. During scheduled review, the job is to analyze results, identify patterns, and decide whether adjustments are justified. Mixing those two modes creates chaos, because it invites reactive changes in the middle of pressure. Discipline during the session and flexibility during review can coexist, but only if they are kept separate. That separation is one of the foundations of professional behavior. Patience and consistency become more reliable when they are built into a daily routine. Before trading, define the entry, stop, and target in advance. Make a commitment to take every valid signal rather than cherry-picking based on how confident you feel in the moment. Judge your results over a meaningful sample, not over one or two trades, and track disciplines separately from profit, because process quality and money made are not always the same thing in the short run. A simple routine reduces impulse and helps good habits survive real market pressure. Ria's breakout strategy is a good example of why consistency matters. During 1 week, 4 valid setups appeared, but she took only 3 of them. That gives her a consistency score of 75%. The problem is not just the missed trade itself, it is that skipping one valid signal breaks the sample the strategy depends on. If results are weak afterward, it becomes harder to know whether the strategy lacked edge or whether execution distorted it. With rule-based systems, missing valid trades creates uncertainty that did not need to exist. This is why it helps to measure discipline directly, not just profit. Record every valid setup, note whether it was taken as planned, and calculate a consistency score from that record. Then review any misses and identify the cause, whether it was fear after a loss, greed after a win, boredom, or second-guessing. A good process day can still lose money, and a poor discipline day can still make money. If you only track P&L, those 2 days can look backward. Process metrics give a more honest picture of improvement. Most breakdowns in patience and consistency are emotional, not technical. Traders act out of boredom, revenge trade after a loss, skip the next valid setup because confidence is shaken, or scale up and move stops in emotionally charged moments. Some also wait for perfect certainty, which is just another way of avoiding normal uncertainty. None of these traps come from the market forcing a bad decision. They come from reacting instead of following the process. That brings us naturally to the final section, where we step back and look at how a longer time horizon can reduce many of these emotional pressures. Section 5. Long-term mindset. A long-term mindset means evaluating an investment over months or years rather than minute by minute. The central question is not what the price did today, but whether the original reason for owning the asset still holds. That shifts attention away from daily noise and toward thesis, adoption, fundamentals, and time horizon. It also means accepting that volatility is normal within a long holding period. Short-term price movement can feel urgent, but not every move is meaningful. Long-term thinking asks whether the evidence has changed, not whether the chart has become uncomfortable. One of the most useful distinctions for investors is the difference between price action and business value. In the short run, prices can swing sharply because of sentiment, momentum, headlines, or general market emotion. Meanwhile, the underlying business, network growth, user adoption, or competitive position may remain largely unchanged. Long-term investors try to look through that noise and examine fundamentals directly. That means checking growth, adoption trends, and the durability of the original case. The goal is to separate fear from evidence. A long-term approach still needs structure. Long-term does not mean hold forever, and it does not mean refusing to admit a mistake. Before entering, it helps to define the time horizon and the conditions that would invalidate the thesis. If those conditions appear, the position should be reassessed rather than defended with vague patience. Real patience stays connected to evidence. Denial uses the phrase long-term to avoid dealing with a broken idea. A costly mistake is entering for one reason and staying for another. For example, a trader may buy a short-term breakout and, after it fails, quietly relabel it as a long-term investment to avoid taking the loss. But a short-term technical trade and a long-term fundamental hold are not the same thesis. They require different evidence, different risk expectations, and different exit logic. The holding period should match the original setup. If the original reason is gone, the right response is reassessment, not relabeling. Managing a long-term position becomes easier when the process is simple and deliberate. Write down a 1 to 5 year thesis, including what must be true for the investment to work and what the major risks are. Review the position monthly or quarterly instead of constantly checking daily moves. You can also define a review trigger, such as a 20% drawdown, that tells you to reassess the thesis without automatically forcing a sale. Finally, measure results over annual or multi-year periods so short-term noise does not dominate your judgment. This keeps decisions tied to evidence rather than mood. Position sizing should also fit the horizon. One simple framework is to risk a smaller portion of the portfolio for shorter holds and somewhat more for positions backed by a longer time horizon and stronger conviction. For example, a 1-year hold might justify risking 2% of the portfolio, a 2-year hold 4%, and a 3-year hold 6%. The numbers themselves are less important than the principle of alignment. Time horizon, conviction, and capital at risk should make sense together. And even with a longer horizon, larger size still means larger exposure to business, industry, and macro risk. Suppose Riley buys 100 shares at 50, creating a $5,000 position. In the first year, the stock falls to 38, a decline of about 24%. That price move is uncomfortable, but by itself it does not settle the investment question. If contracts remain in place, cash reserves are healthy, and regulation still supports the business case, then the long-term thesis may still be intact. In that situation, holding is not denial. It is a thesis-based decision. The key is that the evidence, not the discomfort, determines the response. By the end of year 3, imagine the stock rises to 68 and pays total dividends of 50 cents per share. The position is now worth $6,800 and the dividends add another 50, for a total value of $6,850. Compared with the original $5,000 investment, that is a gain of $1,850, or about 37%. The approximate annualized return is around 11.1% per year. Looking across the full holding period gives a much more meaningful picture than focusing only on the painful decline in year 1. This is one of the clearest benefits of a long-term frame.